Good afternoon and welcome to TAD's webinar, Home Healthcare Industry and Tax Updates. TAD was founded to provide the option for home health agencies to outsource their billing and accounting and consulting services to industry experts. Our esteemed billing specialists, accountants, and CPAs have dedicated themselves to the home health care industry and bring their wealth of knowledge to you today. I'm Mary Reyes, the Director of Operations here at TAD, and I'll be your moderator this afternoon. It's my pleasure to introduce Dan Parker. Dan is the Vice President and a co-owner of TAD. He has his MBA and has been a CPA for over 35 years. He has practiced in the public health accounting throughout his entire career and has serviced the home health industry since 1981. Also, please welcome today Tonya Elkins. Tony is our billing coordinator here at TAD and has over 30 years of medical billing experience, including employment within various home health agencies throughout her career. She has the ability to research troublesome processes within home care agencies and offers practical billing solutions. We have a lot to share with you today, and we're going to get started here. All of our attendees are in listen-only mode, but please feel free to send your questions through the text box right-hand side of your screen, and we'll answer them as time permits. We'll also have time at the end of the webinar if you have other questions that we didn't get to address. I just want to have a disclaimer this afternoon. As you know, this is our industry updates, and things change on a daily basis. In fact, Dan was just telling me today that he was listening in on some conversations with Congress today, some changes. So our disclaimer today is that this information that we're presenting today is as good as today's information. A lot of it won't change, but some still might when you get down into the stimulus information that Dan's going to be addressing later. So with that being said, I'd like to turn the presentation over to Tony. She's going to start our billing section.
And I'm Tonya. Thank you guys for spending time with us. I'm going to be covering the billing updates and as they pertain to the industry updates. My primary focus of attention is going to be on the no-pay RAPs, the public health emergency, as well as the immunization. So under the no-pay RAPs, or vanishing RAPs as I like to call them, there's going to be a major change. For years, we were submitting the RAPs, getting that request for anticipated payment. Medicare would provide the money for providers in anticipation of receiving a final claim to receive the final reimbursement. Again, this was unique to home care because where else could you not provide services and someone would pay you 60, 50% of an anticipated claim to come. But going forward, Medicare, they will be getting rid of that philosophy, and they're going to ultimately replace the RAPs with a notice of admission. Last time this year in 2019, we were anticipating moving from a 50% or 60% payment for those RAPs going down to a 20% payment for a 30-day period. So we knew that there was going to have a drastic financial impact in the home care industry. So I know at TAD, we spent a lot of times with our providers assisting them with their financial planning to get them through at least the first quarter of the year, anticipating that the PPS money would probably last at least through April, being that a final claim that started in the PPS in December wouldn't end until February and not billed until March. So that was the game plan in 2019 to prepare for 2020. How did our agencies do? Well, because of the public health emergency, you probably didn't even have a financial impact because we know the government stepped in and provided a lifeline for our providers, giving them monies that were needed to keep their doors open, as well as backing SBA loans. So financially, again, you probably didn't feel that impact of that payment cut, but Dan will talk a little bit more about that shortly. In 2021, we're going to be entering the next phase of that vanishing RAP, which is where providers will be receiving no payment at all. There'll be a 0%, excuse me, a $0 payment for all providers, whether they were pre-established agencies in the home care industry or those that were newly certified. All agencies will be receiving a zero payment. So if there are going to be zero payments, an agency may wonder, why is it necessary to submit a RAP at all? Well, for two reasons. We know that when home care agencies submitted their RAP, that RAP also updated the Common Working File, or CWF. There, when an agency was doing an eligibility check, you're able to see if, in fact, there was another home care agency providing services, which would give you an opportunity to coordinate that care. So by continuing to submit this no-pay RAP, that process of being able to go in and verify eligibility and seeing if there's another home care agency involved will still be able to be met, as well as when we start moving to submitting notice of elections. Another reason that we will be doing this is because there is a need to prevent a loss of revenue. Also effective 2021, when home care agencies do not submit a RAP within a 5-day window, Medicare will start implementing RAP penalties. The non-timely submission of payment reduction will be applied against RAPs that are not received within a 5 calendar day window, which would include weekends. It's not 5 business days. As for both starter care admissions as well as the subsequent 30-day period. So when counting your 5-day window, the from date is considered day 0. The payment reduction will be equal to 1/30 of the reduction amount, excuse me, of a 30-day period that's applied every day that the RAP is not received. That 1/30 payment reduction will be based on an expected 30-day reimbursement. So for example, let's say your 30-day expected payment amount is $3,000. Well, if you divide that by the 30 days, that would work out to being about $100 a day. So you can see why it's important to make sure that you avoid any delay in submitting your RAP, because every day will cost an agency money. And this would also be true for outlier payments. We know the outlier payment is the additional payment that a provider would receive or expect to receive when they've provided, excuse me again, when they provided care. So you would take the expected 30-day payment amount and you would add that to any additional payment that you would be receiving for an outlier reimbursement. Those two totaled together and then divided by the 30 would be the amount that would be assessed towards a penalty. And remember, the outlier payments are no longer based on the number of visits, but rather the amount of time spent or the length of the service. This penalty is also applicable when it comes to your LUPAs, or your low utilization payment adjustments. In PDGM, your LUPA is no longer 4 visits or less. Depending on your PDGM calculated reimbursement, it can range from anywhere from 2 to 6 visits. If a RAP is submitted and it is untimely, no LUPA per visit payment would be made for visits that occurred prior to the submission of the RAP. So just like with the low utilization payment adjustment, you're not paid according to the period. You're paid based on a per visit amount. The same is applicable for your RAP penalty. It's going to be based on the per visit. So when your RAP is not on file, any services that were rendered prior to that RAP being submitted, those visits will not be payable. Only the visits that have occurred after that RAP was received. Here's a couple of examples. In this slide, we show that we have a RAP, accepted RAP, that was received within 5 days. There will be no penalty. However, if that RAP was submitted and received on day 6, that was 6 days that would be held under that RAP penalty. So even though you may say, well, hey, it was only 1 day after the 5-day window, Medicare is not counting that. Every day in that 30-day is a payable date under that, is a date that can be penalized under that 30-day payment or 1/30th of the payment. So day 6 would be $600, $100 for every day. The same thing would be true if you were 15 days late. Now you're looking at losing $1,500. And if for some reason you don't get that RAP in 30 days or more, that entire 30-day period will be held under that penalty and you will receive $0. So again, it's very important that you make sure that you take the time to focus on getting those RAPs out within a 5-day window, and that 5-day window does include weekends. Here's a calendar example. Let's say you have your start of care on January the 6th. Day 1 would be the 7th. So your 5-day window would end on January the 11th. And let's say you got that RAP in on the 11th. So this entire 30-day period would have no penalty associated with it. All of the services rendered in that first 30-day period would be payable. Now let's take a look at our second 30-day period that will begin February the 5th. And let's say that this second period is a LUPA, a 6-day LUPA. Services were rendered on the 5th, on the 9th, the 11th, the 17th, and the 19th. A RAP assessment that's received at least by the 10th of February would comply, and there would be no penalty assessed against the provider. But however, in this example, it was not received. In fact, that RAP was not received until February the 18th. So services prior to that, which would be the February 5th, the 9th, the 11th, and the 17th, will have all occurred prior to that RAP being submitted. Because this is a 6-day LUPA, those visits would not be payable. Only the visit that was rendered after the RAP, which was the 19th, would be payable. So you would lose those first 4 days of services and only receive a reimbursement for that 1 day. TAD recognizes that this means that the focus is going to be more on not just getting the RAP submitted, but making sure that the RAP has been received. If the RAP has not been received, then the agency stands to lose money. TAD has positioned our company to closely monitor that Medicare not only receive the RAPs, but have accepted it into their system for processing. If you have not already selected TAD as your billing partner, we'd love to speak with you. Just give us a call and we can talk to you about what we're doing and how we can partner together. Also, submitting a RAP that has been has been rejected or returned to the provider for correction, TAD recognizes that these RAPs will not count towards your 5-day window. Medicare knows that it is imperative that these RAPs or these notice of admissions are received as soon as possible. So they have changed some of their requirements, and there are new requirements. These new requirements are the physician orders, or a physician verbal order needs to be received, and at least the initial visit has to be made. With the implementation of the no pay RAP, home care agencies, you no longer have to complete an OASIS assessment. It doesn't have to be locked and export and ready, and you don't have to have that 45 of plan of care completed, established, and sent to the physician. So that's out the window. So in order to get those RAPs out as soon as possible, you only need to make sure that you focus on having that verbal order and that initial visit is received. And that initial visit is for the 60-day certification period. It's not initial visit for every 30-day period. This is important because that multi-RAP submission that I have listed there is something that Medicare is allowing under the no pay RAP submission. Agencies can drop or submit both 30-day period RAPs at the same time. I know that the second 30-day period hasn't occurred, so how can you possibly submit a RAP when you haven't made a visit in that period? Because the initial 60-day certification visit is all that's required, agencies can use the first day of the next period to report on their claims. This will allow agencies to submit both RAPs at the same time or notice of election in the future, and this will minimize the potential for having to be faced with penalties. Your RAP needs to include two things. It has to have your primary diagnosis code on it, and it also has to have a HIPS code on it.
Tony, we have a
HIPS
question.
codes are generated at the completion of an OASIS assessment, and we've already said that an OASIS assessment is not needed. So what's going to occur here is your software vendor. They should have updated their software so that they can assign a default HIPS code on the claim. And that default HIPS code has to also match on the final claim. So your initial billing, it will not reflect an accurate HIPS code. What's important is that when you submit your final claim under the PDGM system, Medicare, when they receive that final claim, they put it through their PDGM grouping system, and that determines the payable HIPS code. So you don't have to be concerned with, well, what HIPS code will I use? Just the default HIPS code will satisfy the edits in the Medicare system. Now, how do you track your reimbursement and so forth? Your software company should also make allowances for your OASIS assessment to be completed and then provide and assign a value, a monetary value for your episode based on the PDGM requirements. So it won't be associated when you submit that RAP within that 5-day window, but when you complete all of the other necessary elements, then you'll be able to use your software to see what is your true expected reimbursement. Now, there are some optional contents that you can report on your RAP. The CBSA 61 value code can still continue to be reported. It's not going to be edited against the Medicare system, as well as your FIPS code, your 85 value code. And other diagnosis codes, if you choose to use them, that's fine. That's an option, but it's no longer going to be a requirement under the new no pay RAP billing option. Now, let's talk a little bit about exceptions. You have this 5-day window that you need to get these claims through, but are there any circumstances that would allow an agency not to be penalized? Well, Medicare has listed 4 circumstances that would apply. If there's something like a natural disaster or an unforeseen event such as a flood or fire, document it, and when you submit your information to Medicare, you can report to them on your claims why that, on your RAP, why it was not received within that 5-day window. And of course, if there's something happening where Medicare, your administrative contractor cannot accept the claims, that would be an excuse, as well as newly certified agencies. Sometimes agencies, they receive their certification, but they have to wait for their intermediary to acknowledge them and to get through the paperwork before they can even begin billing. So those are circumstances that Medicare does recognize. Now, other circumstances that occur will have to be approved by Medicare. For instance, let's say for whatever reason you did report your RAP was submitted timely. However, you have to cancel that RAP and resubmit it. Now you're outside that window. Well, that's the circumstances that Medicare will overlook. You just have to report the excuse when you submit your billing as to why it was not received timely, and certainly keep track of like your document control number as your proof of when that claim was originally submitted and accepted. I cannot emphasize enough that it's more than just submitting a RAP. It has to be accepted. A rejected or a return to provider for corrected RAP does not qualify. You still need to make sure it's received in that 5-day window. And again, weekends are counted. So now let's talk a little bit about this public health emergency. On November 4th, CMS published an article for home care agencies that was entitled CMS Flexibilities to Fight COVID-19. It provided information that the government issued regarding like temporary regulatory changes, waivers, and new rules that would allow providers to respond to this public health emergency. I'm just going to talk about a few, but I encourage you guys to go out to the website and review the article in its entirety. Telehealth was one of the things that that article talked about. Medicare has made allowances for providers to provide this service. It must be a part of the patient's plan of care, and that telehealth visit cannot replace the in-person visit that is ordered on the plan of care. So if it's ordered for 3 times a week services, those are 3 times a week in-person visits that must still be rendered, even if you are using, in addition to that, telehealth services. That telehealth communication could include any remote monitoring system, such as a two-way video audio conference tool, or even a telephone that would be able to provide real-time interaction between the clinician and the patient. Currently, only the in-person visits can be reported to Medicare for home care services. I'm going to reiterate that. Medicare is not recognizing telehealth services as a billable service. That being said, there is some hope. On October 23rd, a bill was introduced in the Senate to provide payment for home health services furnished via the telehealth or auto communication during this public health emergency. So as of right now, like Mary said, every day things are changing, but as of right now, that bill is still pending. As a side note, even though Medicare is not paying for telehealth services right now, this isn't the case for your Medicare Advantage plan companies. Some of them are recognizing and counting them as payable, such as United Healthcare Advantage plans. So check with your Advantage plan providers to see what their policies, what it is right now during this public health emergency in relation to providing this care during this public health emergency. And who knows, if this goes through, maybe this is something that they will look at making just a part of the actual care of patient, because it has proven to be beneficial. The homebound definition was also expanded. This allowed a little more flexibility for being able to provide care to patients. So a beneficiary can be considered homebound due to a COVID-19 diagnosis, the home care agency can provide services under the home care benefit if the physician advises that patient not to leave the home because they have either been confirmed to be COVID positive, or if the patient has a condition that makes them susceptible to contracting COVID-19, and the physician may say, no, stay home. So they may not have the diagnosis, but they have a condition that puts them at high risk. The physician may determine, for the patient not to leave. Under this expanded homebound definition, home care agencies can continue to provide home care services to those patients. And I like this one, the certifying and recertifying patient. This has been a question that has come up periodically. Well, during this public health emergency, a Medicare patient is eligible for home care under the care of a nurse practitioner, a clinical nurse specialist, or even a physician assistant during this public health emergency. These providers can order home care services. They can establish and periodically review the plan of care for home care services, such as signing it, and they can also certify and recertify that the patient is eligible for home care services. So right now, this public health emergency has allowed for more than just that MD or DO or that podiatrist to order home care. These other providers are allowed to, with claims of services that are rendered on or after March 1 of 2020. The OASIS was also given concession. Medicare has eased some of the requirement for the time frames to capture and report the OASIS data. The usual requirement to have the OASIS completed within that 5-day window has been extended. The clinician has up to 30 days to get the OASIS assessment completed. And the requirement for the OASIS to be submitted within 30 days has also been waived. So that doesn't mean that you don't have to submit your OASIS assessment. It simply means that Medicare is providing or permitting the provider to submit delayed OASIS assessment during this public health emergency. But be advised, you still have to make sure that OASIS assessment has been submitted and accepted before final billing, or else your final claim will not process. It still needs to be on file. You just won't have to worry about being cited or being flagged for submitting untimely data for your OASIS data right now. So again, this information is found on the CMS website, and I encourage you guys to go out and read it in its entirety. It has a lot of information that I think you guys will find interesting. And lastly, I'm going to touch on the immunizations. Home care agencies, it's not new for home care providers to provide the flu vaccine and the pneumonia vaccine. This is a service that we have been providing in the industry, and it's been reimbursable both for the vaccine itself as well as for the administering of the vaccine. And just like with the home care industry, there's no copays or deductibles associated with the routine home care service. The same thing is true when it comes to doing the vaccinations. There is no copay and deductibles associated with it. Now, because of this need for the coronavirus, because there's a need to vaccinate because of coronavirus, Medicare has now included home care agencies on their list of approved providers to administer the vaccine. We know that it isn't out there, but when it does start to, when it is approved, they do start rendering home care agencies, you are okay to provide those vaccines. Now, there's a certain amount of fear in the community concerning receiving the COVID-19 vaccine. But however, getting the vaccine in your home brought to you by someone that you already have a relationship with, or you have a certain amount of trust in them, that may soften the patient or reduce the apprehension that a patient may have concerning it. Medicare, again, their goal is to get as many people vaccinated as possible to try to turn everything back around. If you're going to participate, or you're planning to participate possibly in this COVID-19 vaccine, start your plan of action now. Consider how your agency will administer these vaccines in a home setting. Be sure to consider how you'll be able to store these vaccines, if there's going to be any need or changes in order to transport and pack these vaccines. All this stuff you can start to strategize and address right now. Now, as far as billing the COVID-19 vaccine, because the government has already purchased these vaccines, providers will not be able to bill for the vaccine itself. You'll only be able to bill for the injections. The government will be providing the vaccines to us. Also, if you have a member that's a Medicare Advantage plan member, you can still submit that claim directly to Medicare. You don't have to coordinate that with the Advantage plan provider. In fact, because the goal is to inoculate as many people as possible, the government is making an arrangement to reimburse providers for the uninsured as well. So now's the time to start planning if this is going to be something that you will be assisting or participating with. Get your action plan underway. And that concludes the topics that I wanted to cover. I hope this information wasn't enlightening, and I apologize for the technical difficulties in the beginning. Good. Thank you. Mary, back to you.
Okay, thank you, Tony. I'm going to be talking about cost reports for just a short minute, and we might run over our 1 hour deadline due to our earlier difficulties. So Dan has a lot to cover, and he wants to make sure that you stick around as long as you can, and we apologize if we run a little over. So as you know, Medicare requires all providers to submit an annual cost report. And this year, the final rule implemented several changes to the home health cost report. These changes are going into effect beginning for the cost report periods beginning on or after January 1st, 2020. So if you're a calendar year like most of our clients, that means the next cost report you file, which will be due in 2021 for this year, will have to have all of these changes implemented on them. This has been the most significant changes to the cost report. I've been preparing them for 18 years, and this is the largest remodification of the cost report format and forms and such that has gone through it that I've seen. Probably since PPS came into play, they haven't gone through. They're even actually creating a new number and a whole new database format. The biggest change that they're implementing is they're adding the 3 cost centers to capture cost data for LPNs, the licensed practical nurses, PTA, the physical therapy assistants, the COTAs, the COTAs, the certified occupational therapist assistants. As you know, we've been utilizing those types of personnel to provide services. Now Medicare wants to start capturing those costs on the cost report. What that involves is you need to have statistical information regarding all of those types of classifications, as well as the financial center information to allocate costs. So you're going to want to make sure that your accounting information is being able to identify those types of wages and services provided. You also want to make sure that your software company is updated and the reports are allowing you to obtain that statistical information on the number of those types of visits versus the regular skilled nursing visits, regular PT, regular OT visits. They're also expanding and identifying a Medicaid section. So before you listed your statistical information by your Medicare services and all other providers. Now there's going to be the Medicare services, the Medicaid services, and then all other providers. Another area that they're doing, they're expanding in, want to capture more specifically salary information for the direct care personnel. That would be your visiting staff. And what they're looking for is all of the types of expenses, wages, fringe benefits, the number of hours they worked, and average hourly wage. This would also include anybody that you hire as a contractor for contracted services. You need to provide all of that cost information. And when they're talking about wages, they're including sick time, overtime, vacation, holiday, any other paid time off. So it's complete compensation, fringe benefits, and you also need to identify the hours. I know that a lot of payroll companies, we pay by the visit, we don't pay by the hours. You know, there's going to be some information that you're going to have to be looking at your accounting records and start trying to assimilate that information. If you're not comfortable with that, we at TAD, we've been preparing cost reports independently for years. We also provide full accounting services where we can start helping to capture that information. You can shoot me an email. I can put you on our list of prospects for preparing cost reports next year. I normally send out an email in February for anybody who's contacted us that wants us to do the cost reports. At the end of the webinar, there should be our contact information. The other situation, they took the opportunity to reformat the entire cost report. They're changing some of the forms. They've deleted some forms, they've added some forms, they've taken and renamed some forms. What they appear to be doing is to, there were forms in the hospice cost report that reflected the same information that were in the home care cost report that they were reflecting, like non-allowable expenses, but they had different form names. So they've renamed them to be the same name as what the hospice cost report for reflecting those same expenses. So they took the opportunity, since they were making these changes, to really revamp the entire cost report. One of the other things I wanted to mention is that they are including identifying COVID public health emergency funds. Any of the stimulus money that you may have received, the PPP loans, the provider relief funds, if there's forgiveness amounts, which Dan will be talking about all of that in just momentarily, that has to be identified and reflected on the cost report as well. So there's a lot of big changes in the cost report. So if your current provider isn't aware of those changes or wants to do things as usual last year, I would be a little concerned, and I would reach out to TAD and have us prepare your cost report this year. So without further ado, I'm going to hand the mic over to Dan, and he's going to get started on all the stuff you're probably anxious to know about the loan programs.
Good afternoon, everyone. Thank you for attending. I was curious to look at my previous year's slides when it came to industry updates 2019, a year ago, and that whole program seems rather, I don't want to say the word, but I will, somewhat irrelevant to what we face today, day in, day out. You know, we had a year ago the PDGM conversion. We thought we were going to have significant cash flow issues. And frankly, with the government programs that were instituted, whether it be PRFs, Provider Relief Fund programs, the PPP, payroll protection programs, it sort of masked the whole cash flow perceived crisis that we thought we may experience in 2020. Everything seemed to have faded into the background relative to PDGM, and we face now a slew of programs that may continue on further in 2021, We will have issues, as our slide indicates, relative to forgiveness, whether it be loan forgiveness under PPP, whether it's going to be CMS forgiveness under provider relief funds. We have the third category of the advance payments, those agencies that decided to take those payments and now have CMS has pretty much established what the repayment terms will be. Again, it's very far into the future what they did there, as well as what I think to be a critically important issue is what is the taxability of these government-funded programs that offer forgiveness? We'll talk about that shortly. And last but not least, what Tony spent a good time on today was the no pay RAPs. Certainly a cash flow issue going into 2021. There's no doubt about it. We've got some of our client agencies who are very concerned about that. And keep in mind that forgiveness to me will be the very top issue relative to cash flow in 2021. Again, uncertainty abounds, and just like that disclaimer we told you about early on, things are changing. We had, I think 3 hours ago in the Senate, they're talking about the, I think, somewhat certainty of passing another stimulus bill, whether this is stimulus 3 or 4, I've lost count, but they're talking about that as well. Perhaps taking another dip into the PPP program whereby you may have already received a PPP loan. And keep in mind, that was a one-time only loan, at least that's how the program was written. We may be looking at a second go around with PPP monies out there. We'll talk a little bit about that, but let's get started relative to PPP loan forgiveness. As you know, when this program came out in late March, early April, a lot of concern we dealt with was what exactly were these funds to be used for? We had agency clients who were skeptical on whether or not they would receive forgiveness and what exact costs we were talking about. Keep in mind, it's pretty cut and dry. We're talking about payroll costs, not only your wage costs, we're talking about payroll taxes, we're talking about retirement benefits, 401k type benefits if the agency has such a program. We're talking about healthcare expenses, all rolled into something we call payroll costs. We have rent expense, your office rent we're speaking about here. And if you own your own building, rather than paying rent, you may be paying on a mortgage on that building. That also would go under the rent category as to what PPP funds could be used for. And utility costs, whether it's gas, electric, telephone, whether it's internet fees, that all came under the so-called caption of utilities. That was the expenses that were to be funded by PPP monies. Now, as you may remember, back in April, we talked about an 8-week period. You had to spend this money in 8 weeks, not 9 weeks, 10 weeks, or 12 weeks, but in an 8-week period. That got a lot of pushback, and we relented to a 24-week period. Now, keep in mind, 24 weeks is a good long time, and we feel that most agencies will be able to have utilized all of their PPP monies, if nothing else, possibly in payroll alone. So again, it's important to remember that we're now under an optional 8 or a 24-week period. Personally, I would recommend we look at 24 weeks. We're not under any particular severe time frame in applying for the forgiveness. We have 10 months after the last day of your covered period, whether you chose the 8-week period or the 24-week period. The start date for all of this is the date you received those monies into your corporate bank account. That started the clock ticking. So imagine if you opted for a 24-week period, You must apply for forgiveness within 10 months. 10 months primarily is about 43 weeks. It consists of 10 months. So 43 and 24, you're talking about a 67-week period of time between the time that monies were deposited into your account until you must apply for forgiveness, if you choose to apply for forgiveness. There may be some sort of scenarios where you might think twice about it. And again, if the loan is not forgiven in full, or if the loan is not forgiven or partially forgiven, you can then turn that loan into an extended 5-year term loan at a rate of 1% interest per annum, not per month, per annum. And even then, the first payment would be deferred for 6 more months. So we're talking about a 5.5-year period of time. Now, the important thing there to remember is that who you are going to be sending the documentation to, and we'll get into that in a subsequent slide. But this was also issued, this particular guidance on PPP loans, $50,000 or less. On October 8th, the SBA issued guidance as to how they would require borrowers to apply for forgiveness if their loans were $50,000 or less. Now, keep in mind, of the total amount, just to give you an idea how large this program was, there were 5.2 million PPP loans issued by banks. These loans were not issued by the Small Business Administration. They were issued by the banks. The banks lent their own money to the borrowers, and at the same time, the SBA was guaranteeing those loans, so relatively little or no risk incurred by the banks. And so of those 5.2 million loans, 3.5 million, about 2/3 of those loans were for under $50,000. So just to kind of clear the decks and make this whole process easier when we get to the forgiveness period of time, the SBA said any particular borrowers who loan money was $50,000 or less could just self-certify that monies were used appropriately. That's pretty general, isn't it? Just self-certify that we used it properly, and to receive would receive complete forgiveness. In fact, there's now even a form you could go out there on the SBA website, and likely even your own bank website where you borrowed your PPP money from. And under form 3508S is the form that you would use. And really, it's limited documentation that the bank will require, payroll documentation specifically. And a key point to this particular forgiveness on these small loans is that if your full-time equivalents had been reduced and or salaries reduced of your employees, you still would receive 100% forgiveness. This is a critically important point to bring home. Keep in mind, when we talk about PPP loans of greater than $50,000, if FTEs were reduced and or salaries reduced, you likely won't get 100% forgiveness. Again, it's going to be difficult to estimate exactly what forgiveness may be. And this is going to be an ongoing issue. Hopefully clarifications will occur as we go forward. Now, to actually apply for forgiveness, you would contact your bank, your PPP lender, likely the bank that you deal with on an everyday basis. Maybe so, maybe not. There are other people whose bank were extremely slow in processing these applications back March, April, and May. Or there may have been banks that just simply did not participate in the program. However, at the current time, we are looking at 3 forms one would file. The form for those loans exceeding $50,000 would be Form 3508. Those loans that are under $50,000 would be 3508S. And those 3508 EZ forms that would not apply to likely any home care agency that we have. So what will they ask? Keep in mind, what we're talking about here is the bank is requiring this documentation. The SBA is looking toward the banks to either approve forgiveness, not approve forgiveness, or possibly partially approve forgiveness dollars. A likely scenario as far as what type of documentation the bank would require, it would be bank statements for this 8-week, 24-week period that we talked about earlier, third-party payroll service reports, where they could see the dollars paid to employees. You could then also determine FTEs from these third-party payroll service reports. We're talking about the ADPs of the world, the paycheck vendors. As you know, there's a multitude of payroll processing programs or companies out there who will have this type of reports programmed in their software. Also, banks will require payroll tax forms, the Forms 941, filed quarterly with the IRS. They'll want to see them. They'll want to see your state unemployment forms that you file each quarter with your particular state. Proof of health insurance payments connected with your employee's benefit program, proof of a retirement plan costs if you offer some sort of pension plan or some sort of 401k type of matching, that type of thing, or just administration costs, proof of rent payments and lease agreements, and proof of utility payments.
We have a couple questions, Dan. One of them is, what are the requirements to be able to file the EZ form? Okay, he's going to get back with this on that one. He's got to look that up. The other one is, what if the loan is not forgiven? What happens then?
If the loan is not forgiven, it turns into that 5-year term note. You will have to pay that loan amount back over a 5-year period of time on an installment basis at a 1% interest rate. Now, when we talked about this with a couple of clients, and if you think about it, home care agencies have a very, very difficult time borrowing money. Again, being in a service business, you have no hard assets. Banks are very reluctant ever to lend money to home care agencies. Usually they only lend when there's sufficient personal guarantee of the owners. But what we have here is a program that would allow you to actually finance your operations with 1% money, which is not a bad benefit to have gone through this whole process and end up with a 5-year term loan at 1%. That's what would happen if you did not receive either full forgiveness or received only partial forgiveness. Now, the other thing too is we want to talk about the second program. This was instituted by CMS under the Provider Relief Fund. This was monies that healthcare providers received without filling out any type of application or forms. As you may recall, it was primarily based on 6.2% of your previous Medicare fee-for-service revenues of the prior year. And you simply found one day a deposit, a transfer of monies into your corporate bank account relative to what would have been approximating 6.2% of previous year Medicare fee-for-service revenue. Now, here we have the other issue. This is on PRF forgiveness. What types of expenses will you have to have spent this money on? And primarily it's what you see on the screen, anything related to COVID-19, supplies, equipment, staffing costs, employee training costs, any sort of enhancing you may have had to do with your healthcare practices, with your staff as well, technology as to expand or preserve any sort of care delivery that you may have had to incur. These are the types of expenses that will be part of the forgiveness program. When CMS came out with the rules on what documentation will be required for PRF forgiveness, there was one question. They talk about direct COVID-19 expenses, as the previous slide indicates. But number 2 was something called lost revenue. Lost revenue could be added to your direct COVID-19 expenses. And with the direct expenses along with the lost revenue number, that number would then be compared to what funds you may have received under the stimulus. We call it the CMS stimulus program. Now, the difficult thing here is the regulations and the rules, or the Q&As that have been brought forth by CMS, is not crystal clear. So what we've put together is a slide from our understanding of what the regulations would be as of now. And trust me, this may certainly change, but this is what lost revenue by definition, according to the Q&As and the regulations, amounts to be. You would be looking at 2019 versus 2020. Originally, it was a very broad definition of lost revenue. You look at that first line on the slide, we have patient care revenues. 2019 at 750, 550 in 2020. We all thought, okay, that's a $200,000 lost revenue difference. Done, over. No. They then much more clarified what they meant by lost revenue, and it really comes down to operating income, not gross revenue from all sources. Gross revenue would be, and to define what patient care revenue, we're talking about Medicare, we're talking about Medicaid, we're talking about other insurances. All your payer sources go into that top line number called patient care revenue. From that, you would have to subtract patient care expenses. Now we're talking about not only direct patient care expenses, we're talking about indirect patient care expenses. Included in that patient care expense line is something called general and administrative expenses. And we think that that will be further defined and refined. I use that term, defined and refined, because certain G&A expenses do not fall under patient care expenses. They certainly don't, but according to their example, this is how it would be calculated. So let's continue on. So here we got 2019 operating income, 200,000. Operating income on 2020, $125,000. Now, if you incurred direct COVID-19, and I call it direct COVID-19 expenses of $40,000, that would be dollar for dollar forgiven. Meaning you say reimbursed, if you want to use that term for a moment. And so really what that means is that your operating income is really $165,000, because you'll get $40,000 of those direct COVID expenses forgiven. So then now we look at lost revenue as we go further down the slide. You've got 2019, obviously no COVID-19 expenses there, is $200,000 so-called lost revenue versus $165,000. All of a sudden, my difference isn't what I originally thought it might be, $200,000, just because of the revenue differences from one year to the next. Oh no, it's only $35,000. So if you really look at in this slide, what is my forgiveness dollars? It's the $40,000 of direct COVID-19 expenses along with the $35,000 of so-called lost revenue, $75,000. So let's move on from there. And I would like, and I do have a slide when we'll talk about other assistance programs, but let's move on here. I know time is getting a bit short. Now, how does all of these forgiveness programs look as far as the IRS concerned? Is PRF forgiveness taxable? As I mentioned before, certain operating expenses don't fall under patient care expenses. At this point in time, as we sit here on December 1st, any PRF forgiveness is taxable according to the IRS. We're going to see how that holds up as we move forward in time. But as of now, it's taxable income. Now, reporting. How will agencies have to report to CMS to qualify for forgiveness? We have to quarterly report. We will have to report by quarter for 2019, 4 quarters in that year, 2020, 4 quarters in 2020, 8 quarterly summaries of what you saw on that previous slide will have to be reported in that type of format. The end date, of course, for 2020 would be 12/31/20. The reporting date for these 8 quarters of activity is, you can see it right there, January 15th, 21 to February 15th of 21. Now you tell me how you could accumulate this type of data through the end of 2020 and report it within 15 days after your year end. Really, you only have 45 days if you go out to February 15th. I fully expect these dates will be expanded and broadened so that we'll have a more sane reporting period than what we have currently. Now, if you don't fully expend your PRF funds by December 31 of 2020, you have until June 30th, 21 to do so. And then your reporting date becomes July 31. So you can see the difficulty it will be to actually compile this data when you're talking about quarterly reporting. And this is why at TAD, we've got the ability to perform those types of, to provide you with those types of reporting requirements that you'll be have to adhere to. Now, the interesting thing, just a side note, this lost revenue calculation that you saw on the previous slide, CMS will look at the entire year. Then why do we have to report by quarter if they're going to look at the entire year? I don't know. I don't have an answer for you. And hopefully it gets clarified as we go on. Now, the third type of, if you want to call it, relief that agencies dealt with this year was, of course, the advance payment on services to be rendered. Repayments, I should say, were to begin in August 2020. Repayment does not begin for 1 year from the date the advance payment was received. And then 1 year after date payment was received, and for the next 11 months, Medicare will recoup at a rate of 25%. After those 11 months end, Medicare will recoup at 50%. After those 6 months end, full remaining payment would be required, and you could even then at that point have an extended repayment schedule for 3 to 5 years if you show financial hardship. So really, when you add up all those months in that installment program that they've instituted, it's 29 months after you received your advance payment would you be required to pay back in full, spread out over those course of months. Now, we talked about the IRS for a moment, and this is critically important. What occurred on November 18th, just about 2 weeks ago, they had issued the IRS a revenue ruling. The revenue ruling was 2020-27, 2020-27. In that ruling, they said that PPP qualifying expenses were not deductible. And right here, we've got to kind of sit back and think about what this means. Keep in mind that by definition, PPP monies are not taxable themselves. However, on the flip side, those expenses that were paid for by that PPP loan are not deductible. So in essence, that money's taxable. PPP money that is forgiven would be taxable. And you'd say, okay, well, if that's the case, I have to first receive forgiveness to actually have to pay tax on that money. Ordinarily in our accounting world, that's absolutely correct. It would be considered a loan up until that time, which and it still would be until you did receive forgiveness. But the IRS has now ruled that if you have a reasonable expectation of loan forgiveness, and I would say the vast majority of our home care agencies would have reasonable expectation of loan forgiveness, that those expenses would not be deductible and in essence become taxable income in 2020, even though you haven't even applied for loan forgiveness in 2020. Or if you did apply, they haven't yet ruled on this. We think, and I strongly believe that this will change, that there will be enough pressure put on by Congress to change the deductibility nature of these qualifying expenses. So before Congress recessed for the election, there were two bills. Again, as you can see, legislative efforts have so far failed. There's a Senate bill on the floor, 3612, as well as a House Bill 6754. Both of these bills talk about making these relief funds that were used for expenses to be deductible. It was not Congress's intent that they be taxable to you. So as far as time frame forgiveness, we talk about once you have applied for forgiveness, supplied the significant amount of documentation that will be required, lenders have 60 days to review. Once they have reviewed your package, and let's presume at the moment that they have allowed forgiveness, they then send it to the SBA. The SBA has 90 days to review. Keep in mind how this works. The lenders use their own money, these are the banks, to process and to give to you the loan money. The SBA, upon forgiveness, will then pay the bank directly the amount of the loan that they had sent to you. So that's why we've got SBA review as well. Now, if we want to talk about a timeline, I really don't think you're going to see much forgiveness coming out until the end of the end of the second quarter of 2021. So when I talk about sort of what my concluding point would be on forgiveness, I would say I wouldn't file for loan forgiveness until the questions that surround the tax deductibility of the expenses have been clarified, and I think they will change. And I didn't mention this until now, at one point there was discussion about automatic forgiveness. And the number that they kept throwing out was $150,000, meaning to say if your PPP loan was $150,000 or less, you would have automatic forgiveness. This never got into any sort of legislation. May it come into future legislation? It may. You got to keep in mind what we're looking at. The Senate and House are both in session as of yesterday. The House recesses December 10th. The Senate recesses December 18th. Discussion today centered around another PPP program of $300 billion, 300 billion B. And so again, no mention of the tax issues involved, but I'm sure we are putting all hands on deck from a lobbying standpoint to make those expenses deductible. So I would have, who knows when a bill may come out. Keep in mind this, the Congress recesses, the Senate on the 18th of December. They don't reconvene until early January. We've got a new administration coming in on the 20th of January. Again, uncertainty is the word of the day. That's what I have to say. Just stay tuned, and I will say this to you, that from our standpoint here at TAD, it is critically important when you ask for forgiveness, whether it's on the CMS stimulus money, whether it's your bank PPP loan money, you only get one chance to send in this documentation. And we would love to be able to assist you in this task so that what you do put forth will please the bank and have those PPP forgiveness and CMS forgiveness dollars actually forgiven.
Thank you, Dan. And I know we ran over. We were having a little bit of technical difficulty, but we still ran over. And I thank all of you for staying with us through all of this information. I know there was a few questions that we we're tight on time. If you have them and you emailed them in, I'll send an email out to you sometime by the end of the week with answers to the questions that were done. Here is our contact information. You can send emails to tad@tad-usa.com or call the phone number attached there. That phone number will be directed to me, Mary Reyes, and I will be happy to talk to you about our services and direct you to information if you're just calling about questions. So as you heard, there's a lot of changes going on in our industry. TAD has always got their pulse on, their eye on the pulse of the changes, and Dan is constantly updating information to make sure that we have the correct information to provide you with solid accounting and financial assistance for all of our clients. So if you are interested, I'd love to talk to you about our services. So thank you again for attending today. There will be a questionnaire that pops up when you sign out. That's another place where you could ask for information for us to contact you directly. So if you could please provide us that feedback, I'd appreciate it. And hope you have a nice day. And thank you for attending today.